Let me tell you something that will sound wrong, but it's absolutely true. Markets don't crash on bad news. They often rally because of it. Recessions, weak data, slowing growth. This is not what scares institutions. This is what sets the stage. If you've ever wondered why markets go up when the economy looks terrible, stay with me. You're about to see how the system really works. Retail traders believe this simple story: bad news equals bad markets. Good news equals good markets. Central banks and institutions play a very different game. They don't trade the economy. They trade financial conditions. And bad news gives them something powerful: justification. Justification 2. Cut interest rates, inject liquidity, slow tightening, or pause policy. Bad news isn't a problem, it's permission. Here's the mechanism most people never see. When economic data weakens, growth slows, unemployment rises, inflation cools. That reduces pressure on central banks. And when pressure drops, expectations change. Rate cuts get priced in, liquidity conditions ease. Risk appetite increases. Markets don't wait for stimulus to arrive. They front-run the response. By the time headlines say, central bank may pivot, institutions are already positioned. This is where retail traders lose. They read bad news and think, the economy is broken, I should be careful. Institutions read the same news and think, liquidity is coming, let's get positioned. So retail waits for clarity. Institutions build positions in uncertainty. When the policy response becomes obvious, the move is already done, upside is limited, and late buyers become exit liquidity. Bad news didn't hurt you. Late understanding did. Humans react to headlines. AI tracks cause and effect. TraderWise doesn't ask, is this data good or bad? It asks, does this increase the probability of easier money? That's the question institutions care about. Because risk assets don't rise on optimism, they rise on liquidity expectations. So here's the question, and think before you answer. When bad news hits the market, do you fear it? Or do you ask what it allows central banks to do next? Because once you understand that, you'll stop being confused by rallies in weak economies. Comment, liquidity, if you want to learn how institutions really trade bad news.